Hello and welcome to this interview here on Money Paathshaala. Joining me today is Himanshu Kohli, someone who has been associated with the wealth management industry for almost 3 decades. He has been the co-founder at Client Associates, a wealth management firm that focuses on family offices. And that itself is something that he's been running for more than 2 decades. Thank you very much, Himanshu, for coming by. HNIs, family offices, thanks to people like you who advise them, seem to be always picking up trends before the retail investors follow. So therefore, I thought it's a good time to get your views on what your clients are doing. What are you recommending to them? So first question on the equity markets. A lot of discussion, debate on where the markets are headed. What is it that you are advising your clients and what are they doing at this point when it comes to equity?
First of all, thanks, Vivek, for inviting me over here. It has always been a pleasure to speak to you. Coming to your question on what we are advising clients at this point in time, specifically related to stock markets, I would say our advice has been always very consistent. What we advise is a discipline. And discipline comes through a very simple and scientific approach, which is called as strategic asset allocation. Because we believe there are four things which impact the success of any investor globally in India. One is your strategic asset allocation, second is market timing, third is which product to buy, and fourth is luck. Empirical data has shown time and again that 90% plus success comes if your strategic asset allocation is correct. Market timing, which product to buy, and luck contributes less than 10%. Unfortunate part is most of the investors, they spend 90% of their energies in either timing or which product to select and hope the luck to favor them. And they forget the big picture on their asset allocation. Coming specifically to the stock markets today, let me just take two scenarios. One scenario is, let's say a client has a 50% equity portfolio and 50%, let's say for simplicity case, say fixed income. Today markets have run up and 50 because of markets run up in last 4 to 6 months has become 55% of his portfolio. One approach is to sell 5% and become 50%, that is rebalancing the portfolio. But also what has happened is today valuations have become slightly more expensive. And our model says today in place of 50%, one can be comfortably consuming 43% because there is a 13 to 14% overvaluation in the market. So our biggest advice is stick to your asset allocation, forget the greed part of it, maybe sell 12%, 5% move into fixed income, and 7% move into cash, which can be systematically built up into equities over a period of next 6 to 12 months period. That is something which is our advice to a client whose portfolio is matured. Second, let's say a client has not built up the portfolio but wants to build up 50% and is sitting all in cash today. We are saying, okay, fine, maybe 10 to 20% you can do lump sum investments into equities and balance you do it over a period of maybe 12 months. If you're very aggressive, maybe 6 months. If you want to be extremely conservative, next 18 months, build up the equity portfolio. So that's what we are advising our clients. Right now, it's a time to give away the greed or the emotion of greed and become more pragmatic. And there's an opportunity to book some profits. If you have not entered systematically.
Himanshu, when it comes to family offices or HNIs, there are so many more avenues that have opened. Of course, PMS happened a long time back. Now you have AIFs, which are taking off in a big way. So other than the plain vanilla, go through the mutual fund, buy equity directly or through a mutual fund, What are the other avenues according to you? We've seen a lot of family offices, and I'll talk about that in more detail. Investing in startups. So, what are the other avenues that family offices are looking at this point of time?
So, Vivek, there are four trends which are happening in our society. First one is financialization of savings. People are moving more from physical assets into financial assets, and that is something which we have witnessed over last 5 to 10 years. Last 5 years, very, very aggressively. Second is people are also looking at building up equity as their major asset class. 20 years back, when we started CA, SIP of $1 million was the Economic Times front page news. You have seen now, last 3 years, continuously $1 billion plus is happening on a monthly basis. My sense is this number will go up to $1 billion per week over a period of time. So equity is becoming a long-term investment asset class and the major asset class of families today. Third is unlocking value in their traditional businesses or traditional properties and putting a part of that into new age businesses, which is where there's a lot of buzz around entrepreneurship, which is happening in our society. And fourth, even if India is very, very attractive and it can create a fortune, but putting all your eggs in one basket is not the best of things. So diversifying beyond India is also another theme which is going on for last 5 years. Like this number 10 years back was $1 billion. Last year, this number was $19 billion under the LRS scheme. So these are the four trends which are happening. So if we ask about our clients, and I was looking at the data when we had a recent quarterly review, last 3 years, the biggest net inflows have gone into equities, which is primarily equity PMSs and AIFs. In fact, mutual funds, frankly, we have not seen any inflows, net inflows. It is majorly towards equity, PMSs, and AIFs. Besides this, there is also a large chunk of money which has gone into debt alternatives, which is absolute return strategies, venture debt, high yield credit funds. These are the areas which have attracted the second biggest allocation. Third biggest allocation which has happened is on the private equity and venture capital side, where people have invested into funds to participate in the entrepreneurial story. And fourth is maybe other alternate ideas, whether it is a fund of funds to participate in the international markets or LRS route to get invested in the international markets. We have seen reduction in the cash or the liquid funds. Fixed income has not increased. Balanced funds have remained over there itself. But primarily, these are the areas where majority of the fresh inflows or net inflows have gone over there.
Himanshu, there is a whole talk about funding winter, and how startups are finding it very difficult to raise capital of the kind that they were doing earlier. I mean, we are still seeing, some startups being able to raise money, but we keep reading a lot about family offices, stepping in and putting money continuously. Of course, their entry points are very different from the big bulge bracket VCs. But do you see any funding winter there when it comes to family offices investing in startups?
So I would say definitely, Vivek, family offices are looking at a certain percentage of their money towards unlisted side. That number is broadly at about 20%. They are looking at it through a funds route or direct investments. Yes, 2021 was a year of a lot of excitement, but also a lot of bubble was building up because valuations were just going unreasonable uh, to the roof. 2022 was a year of great learning which happened, whether it was with fund managers or it was with family offices. And those learnings they're applying now in a more disciplined manner in 2023. So I would say startup world is very exciting. It brings a lot of cheer or excitement or discussion points when you speak to family offices. But Vivek, last 28 years, I have seen discipline is the most important thing and is the best friend And there we come into picture as an advisor and say, how can we be disciplined in a world which is so exciting also? Make it as boring as possible, because if your investments are giving you too much of excitement, that means you are not doing too well. So there I would say some of the processes which we have been always talking about, family offices have started respecting those processes, creating an investment policy statement around this, the process to build up the portfolio, make it as boring as possible, detach themselves from the decision making, maybe let the process decide rather than the emotions deciding. So there has been definitely a period of learning which 2022 taught all of us. And good thing is people have taken it in a very positive spirit and bringing that learning into their investment thesis in 2023.
Uh, Himanshu, real estate has been one of the favorites. You made the point earlier about financialization and the fact that equity is being seen more prominently. But when it comes to businesses or family offices, perhaps in the past, the focus was that let me build my own business. That's the equity part. And for my investments, let me go and buy lots of real estate.
Right.
Is that something that is changing dramatically? Because we still keep seeing a very significant increase in sale of luxury homes, not so much in the affordable housing space as much as in the luxury space. Is that something that continues to be an emotional issue for family offices that, okay, let me, I'm seeing a good deal, let me just go and pick up more real estate. Perhaps my children, grandchildren will, get that real estate. Is that something you're still seeing?
So I would say one, Vivek, things are changing. Like earlier, people used to not differentiate between their personal wealth and their business wealth. So they used to think that my equity is my business, and then outside business, I'm looking at maybe real estate as the major asset class or the only asset class. Today, they want to demarcate between their personal wealth and their business wealth, and they want to be financially independent from the business. So when it comes to surplus outside the business, they then want to create a portfolio outside, uh, into equities, into property, into fixed income, into alternate asset classes. So that is one trend which we are seeing. Coming specifically to real estate has always been closer to Indians' heart. But as the time horizon goes by, emotional values are coming down, economic values are increasing, and people are taking more pragmatic rather than emotional decisions. Earlier, people used to say, okay, fine, let me buy a couple of properties, maybe two, three, 10, 20. Today, they find it more of a headache. They want to simplify their life. And they've also seen if you invest in the similar manner, the way you invest in property and keep it buy and hold from a long term perspective, other asset classes also do justice, not only in terms of returns, but also in terms of risk, in terms of liquidity, in terms of taxation, in terms of administrative ease. All those things have started happening. So I would say, yes, uh, people are diversifying beyond business. Then outside the business, which used to be primarily property, it's more diversified portfolios. Luxury properties, yes, they have gone up. Reason being, there is a higher demand than the supply because number of HNIs which are getting in our society, they are growing at a very, very rapid pace. Like every 30 minutes, as per the World Wealth Report, there's an HNI who is born in India. Every 30 minutes. Every 8 days, there is a UHNI who is born in India. Every 40 days, there is a billionaire who is born in India. So the pace at which wealth creation is happening over here, anything which is catering to the HNI segment, whether it's the luxury real estate space or luxury goods, they will always be in demand. And that's the reason luxury real estate prices have gone up because of the sheer pace of growth which has happened in the HNI segmentation in the society today.
Himanshu, it is said that most billionaires the world over have actually built their wealth through long-term equity investing. Of course, in the Indian context, we've had lots of businesses, as you've outlined, who were probably not that attuned to equity beyond their own business as they are now. Can you tell our viewers a little about the power of becoming, say, a billionaire with the power of equity and power of compounding?
Right. So one name which comes to everyone's mind is Warren Buffett. He has become amongst the top 10 richest individuals in the world. And he has used the magic, which is the eighth wonder of the world, which is power of compounding. In fact, I was analyzing the data, Vivek. Last 30 years, his wealth has grown at a compounded rate of 9.8% in dollar terms. Dollar has moved by 3.3%. So in effect, he has earned about 13% in rupee terms over last 30 years. And that has benefited him and he has become amongst the richest person in the world. That is something where we always keep focusing on returns. But there is three factors which actually creates the success or create unicorns. That was the magical formula. The formula is how do we create the highest future value? Future value is nothing but present value, PV into 1 plus R, which is rate of return to the power of N. That N makes a lot of difference. So we just keep emphasizing on the rate of return or how much you keep investing. But also there is a sheer power of compounding which comes through nth number. So just to give an example, let's say if you invest a crore of rupees and invest it at 7%, which is what India's asset allocation invest. In 50 years, someone who is 30 at 50, at 80 years, will be able to create 30 times 30 crore rupees out of it. But someone who compounds it at 12%, which is only a 5% differential, not even 100% more, 5% over 7%, which is 12%, can make a differential of 10x. So that 1 crore rupees becomes 300 crores over a period of 50 years. That's the power of compounding. So one, how much we invest makes a difference. What rate of return we target makes a difference. And third, how much time do we give? That makes a difference. So this is something which is, I think we are blessed to work with some of the progressive mindsets. We just need to sit down and say, okay, fine, we need to really think long term. So today our challenge is discipline and long-term thinking. And if we just go to our investors and say, okay, fine, just focus on these two things, the rest all numbers will do the magic for you. You just need to control your emotions and be disciplined. Now, whether it is health or similarly it's financial health, which is a wealth part of it, that makes a lot of difference. And long-term actually is the right way to go about creating real future value.
Absolute pleasure speaking to you, Himanshu. Thank you very much for taking time out. I do look forward to many more such conversations with you. This is inspiring. Retail investors would do well to listen to such commentary because, if they too aspire to be like some of the big businesses that you represent, then these are some of the learnings that we all need to follow. Thank you very much for your time.
Thank you, Vivek. Thank you. And it's always a pleasure to speak to you. Thank you for your lovely questions. Pleasure speaking to you.
Thank you.